Anna, let's talk about 48.25 year end on the S&P 500. 48.25 and then something closer to 4,700 next year. Just frame the view at Wells with your buddy Chris Harvey for us.
Well, I think for this year, and what's really given us confidence into our price target for the next 2 months, look at how 3Q earnings have been coming in. As much as all we hear about is supply chain issues, labor costs going up, labor shortages, really, what we're seeing is that margins have been growing overall for the S&P 500 companies. That's telling us that this earnings growth has been robust. And it's partly because, like you guys were talking about before, that demand has been rather inelastic. Demand has been booming. And it's helping us and our prospects going into year end. But like you said, now for next year, for 2022, we're going to see tapering start to finish probably around mid-year. Then you're starting to see rumors about that rate hike being priced in. And that's the kind of environment where we're shifting from this more mid-cycle to late cycle.
So, Anna, your SPX calls Dow 37,500-ish. You know, who knows? And maybe we'll overshoot to SPX 5,000, which would be remarkable. On the way up, adults are going to come to you and say, we must hedge this great bull market. And yet with this convexity, this acceleration, hedges become so expensive. Is that where we are now, that you can't intelligently hedge a great bull market?
Well, as the pace has been accelerating, what's been interesting is you look at the volatility markets and you're seeing that implied over realized is actually not too expensive right now. I think a lot of that's been brought down by the additional confidence in earnings growth and just sort of the better outlook and clarity we're getting. So in fact, hedges, I don't think hedges are that expensive here. I think it's possible. You just got to pick your time frame.
And this is, Lisa, this is absolutely critical, and it's an indication that this is not cathartic. You're not getting the emotion as indicated by expensive hedges where you go, I can't take part.
And part of this is, how do you bet against a market that seems, by some, maybe would call Teflon-like in its appearance in terms of rallying? Honestly, Anna, I do wonder how much this hinges on this idea that there still is so much liquidity in the market based on where the Fed is in their policy, that even if they become a little more hawkish, if they start to taper their bond purchases, you still have negative real yields of around negative 1% on the 10-year yield in the United States. How much is this driving everything at this point, regardless of fundamentals, regardless of what story you tell in the economic cycle?
No, Lisa, you're absolutely calling out that big elephant in the room. Even if we start tapering, these purchases are massive. This is the most monetary liquidity we've had in quite some time. And don't forget, we've had a lot of fiscal stimulus down the pipeline as well, perhaps more coming. So in that kind of environment, it's helping people and it's giving us that flexibility to spend and to move markets around. I think that as that tightens, tapering is just the beginning. And even yields are still coming off very, very low levels, and credit, while it's widening off tights, it's still historically low. So all that context, it's a great point. I think that's a lot of the reason why I'm enjoying the sort of boost we're seeing now.
Anna, just give me a second. This could be one of the biggest contrarian indicators we've had in quite a while. Lisa, are you sounding a little bit bullish?
No.
Are you sure?
I mean, what is bullish?
Tom, would you go there? Did it start to sound like that, Tom?
Is this Kantian theory? What is bullish?
Well, thank you.
What's going on?
Honestly, Teflon is what the market has been doing. And I do wonder, John, to the point, how much is this just completely backed by the Fed? Don't bet against a Fed that is still accommodative.
I'm going to start screaming.
We got you there. We got you there.
Please do.
John, you're just doing this to get me going.
It was beautiful. Go on. TK, the floor is yours.
I've heard this so many times, John. It is the conflation of well-intentioned macro analysis into the bid-ask of the market, and particularly of the stock market. And you got to combine that in with a careful Gina Martin Adams, Anna Hahn kind of analysis.
Just to confirm, Lisa is not bullish based on what Lisa just said. Are we done with that now, Lisa? That flirtation with that constructive view?
I'm not bullish or bearish.
You're not?
I'm trying to look around corners that have negative things there, because that's what the corners are that are concerning.
Thank you for clarifying.
Anytime.
And a final question. How big is the Fed's involvement in this equity market?
It is undeniably large. And if anything, the Fed has made sure to communicate their stance because they know the impact on the equity market. And, to Lisa's point, there is going to be one sector we're looking at in particular, the favorite, tech, that is going to be having a harder time if real yields start to take off. And I think real yields will start to move higher away from these negative territories.
But Anna, they haven't yet. That's a fact, right?
Mm-hmm. Yeah, what's been interesting is as we are getting this consensus on tapering, you would expect real yields to really start picking up. They've been going a little bit the other way lately, and that's what's giving us pause. Talk about looking around the corner. That's a little point of the market that we're wondering, is this signaling something different to us? But I think you need to give it time. We're looking on this day-to-day framework. We need to think in months and quarters ahead.